All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Let's go out and take a look at, continue with our 30 Indicators in May series. We've gone out and looked at a lot of indicators so far, things like the RSI, the Bollinger Bands. We've looked at parabolic SARs. We've looked at quite a bit. But there are two indicators that I find to be extremely useful when the market is in different types of periods. One, when the market's kind of like what it is right now, what it is today and what it has been the last couple of weeks. Another, where it's really good when the market has been in a trending type of style or trending type of environment. And if we see that kind of reemerge, you're going to see lots of buy signals really come in strong with it. And so let's go take a look at these two indicators. The first is the Commodity Channel Index, the CCI. And when I go and I want to trade short term, or not day trade, but I want to go out and I want to buy and sell, based on catching some of the big dips and the big rips that we tend to see kind of happen in the market. I don't need any other indicator. It's the only indicator I need. And that is the Commodity Channel Index, the CCI. This indicator, and you'll notice I'm applying it here to an hourly chart, okay? To an hourly chart. This is my favorite application here. But this indicator does a really good job of spotting extremes. It works well for indexes. It works well for currencies, for commodities, for stocks, and just can help you kind of play counter thoughts or counter trends that come into the market. There's two ways to kind of look at this, and the indicator is down here below. And you can see it ranges from 400 to, this one minus 350. But that's kind of normal range for most stocks. When a company reports earnings or they have a big gap up in the stock, generally the CCI is going to surge. And anything above 300 is where I want to look at downside reversal opportunity. That is overbought. When we start to get into the 200, 300 area, we're talking about being overbought, and overbought in a way where we tend to see reversal. Same thing on the downside. We tend to see this indicator go lower when we become oversold. You'll notice if you compare this to something like the RSI, it's going to become overbought and oversold a lot quicker. A lot quicker than something like the RSI, a lot quicker than something like a MACD, a lot quicker than a lot of indicators that are out there, and that's why I like it. But basically, it's looking at the price range of a stock and kind of ultimately the momentum of a stock over a certain day period, in this case, 20-day period. And it is looking to kind of see, okay, is the stock changing to a greater degree than its normal price change? For example, take a look right here in Caterpillar. Caterpillar every hour, has a certain price change, an average price change. But then we get this hour right here where there's an explosive price change. You'll notice that's a big move in the CCI. So the CCI is helping us to find areas where we're seeing an explosive price change. Now, what does that entail? Well, when a market is like today, or like it has been the last week and a half, explosive price changes are the norm, right? We're going to see them happen. And so you're going to see the Commodity Channel Index dip as a stock dips. But you'll notice none of these dips, even though the stock dipped a lot more than it did right back here in April, right? The stock dipped, but it didn't dip anywhere near the same magnitude as it did yesterday. You'll notice the CCI is a lot lower back here in April than it hit yesterday. So it takes this relative movement into account, which is really nice and something where, when you have an indicator that's kind of taking the relative action into account, it tends to be more valuable than an indicator that doesn't. And we see that with the CCI. And so how do you play the CCI? Well, you take a look at it with the stock, and let's come here to IBM. There's a couple ways to play this. First way is to look for the indicator to go below minus 200. When it goes below minus 200, the chance of a reversal that day is high. And generally, it's going to go below minus 200 on a gap down. Right here. Came all the way down to minus 550. The chance of reversal is very high when we see this. It's not always, but it's more often than not. Take a look at this gap down right here. Minus 250 on the CCI. Stock got bought up throughout the rest of the day. Right here, we shoot down to minus 300 on the gap down. Stock, nice little intraday rally. You'll notice yesterday the stock gapped down and moved down pretty big, had a big move. But you'll notice the CCI didn't go nearly as low as it had these other previous times. What's the significance here? Well, we saw it happen the day prior as well. The significance here is that when the CCI starts to move back over 100, you can be a buyer. There are two ways to play this. You can play this with an extreme and say, hey, I'm going to look to short when it's in a severely overbought condition, or I'm going to look to buy when it's severely oversold. That's the easiest way. That's the most straightforward way. Perhaps the most profitable way is to look for divergences. Where yesterday, you see IBM sell off. It goes to a new low, but the commodity channel index doesn't get anywhere close to as low as it had prior on Thursday. Then you see the move back above 100, and this has happened twice. And you see the move back above 100. There's your buy signal. Now, it's only for that day, right? You're only looking at a buy signal for that day. You're looking to play it that day, but generally you can get a big move in the stock. You can get a sizable enough move to trade options off of. And it's one of the best ways of playing some intraday options. This morning, we saw IBM gap up, and what did we see? We saw this fresh move back above 100 again. There's a reason I'm showing the stock, right? This is something that I used this morning to go and to grab a little bit of the trade. Now, I'm out already. I didn't get greedy. I just took about a $1.50 move. But this movement on positive divergence back above 100 is very buyable and a lot easier to trade than a big spike down. This big spike down from an option standpoint, a lot of times the options are going to be a little more expensive, right? They're going to be a little more expensive because of the implied volatility. So you have to adjust the option you're going to trade. But you can find major bottoms or major tops when this happens. And so when I see a stock of mine, like an IBM, which, you guys know I was short. And when I see a stock that I'm short come into this area and become oversold to this degree, I look to take it and say, all right, I'll move on out. Yep, sometimes the stock will continue on lower a little bit, but it's time to take it. And so I like the divergence for entries. I like the over extreme areas for exits. But one of the things about the CCI is each stock kind of has its own rhythm, its own nature, right? Here's Bank of America. This CCI looks a lot different. right? A lot more pops and drops and extremes. I mean, here we had Bank of America yesterday. The CCI came here to minus 300. It's pretty extreme. Here we have the divergence in the CCI right here. And you'll notice it took a few days for the stock to rally, but managed to make it. This morning, I'm watching Bank of America, just wondering, do we dip back down and get some positive divergence to buy? Never got it. So, I'm not in. I didn't trade it. But, here we are with this ultra extreme. And when you have a stock that you like, when you say, hey, you know what? I really like this stock fundamentally. I've been looking for an opportunity to buy it. And you think about that old adage. Buy when there's blood running in the streets. Sell when there's people pounding at your door. There is no other indicator that epitomizes that adage like the CCI. When the CCI pops up here to minus or positive 300, that's people pounding out your door. That's generally a pretty good time to get out of a call option. Right here, Bank of America gave a breakout on the daily chart that I really liked. And I looked at buying it, and I thought, do I want to put on a big position? And I looked at the CCI on the hourly and said, yikes, I can't. So I still got a little bit of Bank of America, but I just bought what I was willing to risk. I sized down my position a ton, and I bought out of the money, and I said, if this goes and it goes big, boom, it'll pay me off. If not, great. I don't have to worry about it. But what made that decision from putting on a normal, sizable position and playing the breakout versus, let me just do a small spec position? The CCI, right? And the extreme overbought nature that it was. Extremely oversold here yesterday, like a lot of stocks. And a lot of stocks hit this period yesterday, and a lot of those stocks are doing what today? They're rallying. And especially in a market where we get the average true range rising, when we get the magnitude of movements increasing to the degree in which they are increasing right now, this commodity channel index is one of the best indicators to play counter moves. Just to play that move in the opposite direction, that move that you look at and say, man, it's got to be coming. Here's Facebook. We came into not as severe of oversold condition as I would like to see. I would have liked to see this thing down in the minus 300 area, but it came down to minus 250. Then set a new low. What's happening with it right now? It's pushing back above 100. We have some positive divergence here. Great, there's my signal. I can go buy it. Is it an easy buy? Is it a no-brainer? Is it a, hey, of course let's buy it here because of course it's going. No, it's not. It could be a type of a buy, right? When you're playing with the CCI because you're doing something that's so counter-trend that, it's you don't have a great stop point. It's not like you can say, well, I'm going to buy it and I'm going to stop out here or here or here. Right? You're dealing with extremes. You're dealing with a stock that has these big movements, and so, stop points, they're just going to whipsaw you out and do you no good. So they can be difficult to want to enter. And so choosing your option appropriately and your exposure appropriately is very important. Right? Is very important. Now, I'm not bullish enough on Facebook to go and buy this signal. IBM, long term, I'm very bullish on. Facebook, not so much. So that bias of mine keeps me out of Facebook, keeps me from buying Facebook, even though I have the signal, and the signal is likely to, get some work, likely to do some good here. But you want to apply it to your biases. You're looking and you're saying, I'm looking for a pullback buy opportunity on one of your favorite stocks. The CCI applying that and buying it when that CCI hits extreme levels. Great. Adding stock positions or trading stock positions. This becomes very nice. You can come into a daily chart. right? And, one stock that, let's go to gold, right? You know me, longer term, I'm very bullish on gold. I'm looking for positions to add gold, right? But I'm just buying it in pieces. I'm not buying it all together. But when do I add? Well, every add that I have made to gold has been with the commodity channel index in an oversold condition. Am I adding today? No, not at all, right? Not at all. In fact, by the end of the day, I may look at this and actually subtract a little bit because of how overbought it is. But this is something where I can say, all right, I'm looking to build a position in XYZ stock or this commodity or the market, and you start building in these spots where the CCI becomes oversold. One stock that I would like to start building a position in, that I would like to be long for, an extended period of time, Ford. I think Ford has changed. I think the model here with Ford is changing, and I think this has a decent shot of being a $20, $30 stock in the years to come. I don't have a position on it yet, right now. But I'm also not looking at it every day and going, well, do I buy it today? Do I buy it now? What do I do today? Should I add it now? No. It's a very simple decision for me. Here's my CCI. We start to come into oversold territory. Boom. There I'm going to look to add. So if I take my favorite stocks and say, hey, you know what? I'm going to look to add to these when they become oversold on the CCI, IBM, there's my opportunity to start to build positions. You know me, I've been bullish IBM, and we saw kind of the game-changing nature back here, and we saw the earnings here in January. But every time this has become oversold on the CCI, it's been a decent add point here for a long-term position. So you can use it from a short-term trader standpoint to look to play some of the volatility and whipsaws on an hourly basis, or you can use it in a longer-term basis to start adding positions and even subtracting positions as they get into these severe overbought and oversold conditions. So that's the commodity channel index, one of my favorite indicators. And in fact, if you gave me any indicator to go trade with and said I can only have one, I would take the Bollinger Bands. But man, I would definitely be tempted by a commodity channel index if the market itself were a volatile market. That's how much I value the CCI and, think what I think of the CCI. Now, there's a similar indicator in how it looks, but very different in how to use it. And that is the Williams %R. And this indicator works in a similar fashion where above 20 is overbought, below 80 is oversold. But you'll notice a lot of whipsaws, right? A heck of a lot of whipsaws here. And this is an indicator that I ran into back in 2007. And I ran into a trading system that a gentleman was using. He was a chiropractor. And he was getting out of chiropractics and, starting to trade. And he had had some really good success with this, especially in 2006 and 2007 when the market was in a nice kind of just general trend. I started following it, kind of watching it, trading it a little bit, and then the whole system fell to pieces really fast. At the middle of 2007 into 2008, had no validity, just zero value in terms of using. And as the years kind of went by, I keep going kind of back to it, and it's very clear. It's a fantastic system if the market is trending. It's an absolute terrible system when the market is consolidating. But what's the system? The system is you take your favorite stocks, your best fundamental stocks, and when they become overbought, you buy them. You simply buy them. And you stay in as long as the stock is above a 20-day moving average or a parabolic SAR, whatever type of runner you want to use. In this case, let's just say 7 or 20-day moving average. Where are you in? You're in right here. Where are you out? Well, let me throw the 20-day moving average on here. Right? So here you're out right here on this breakdown. You're in right here. You're out right here. Great. You're back in right here. Right? You're back in. You're back out right here on earnings. Yep. Didn't make any money. Right? But to find trend or to play a trending type of market, trending type of environment, it can be extremely valuable. Knew a guy back in 2007, and I showed him this system, and he was trading dry ships, and this is a shipping company, and he did something very interesting and very unique. And I show this because, it has a lot to do with the 100K challenge philosophy and mentality, and a lot to do with some of the origins of it. And, it doesn't want to go back and give me that data here. 12/31/2007. Yeah, they went through a restructuring. So they're not going to give me the past data here. But bottom line is dry ships went from a $2 stock to a $120 stock. Let's see how far back this is going to give me here. Yeah, so after the restructure, so it's there's I'm not gonna be able to pull the data, but basically what he did is he went and bought on this buy signal when the Williams %R became overbought. He would go and buy an out of the money monthly option, and with how dry ships was moving, he would double, triple, quadruple his money within a couple days. It was just moving like that. If the buy signal was still intact, he would take the cash off the board and he would roll it all up into the next month out of the money option. He wasn't taking any of the gains and pocketing them or managing exposure in any way. He was just upping the amount of money he was putting in and just rolling his option out, rolling it month out to a out of the money strike, out to just a little bit more time. And he managed to go from $2,000, and one day he sent me his account, and it was $120,000 in a matter of months. In a matter of months doing that strategy. It was really cool. It was really awesome to see. And he was using this Williams %R. He was using this kind of goes into an overbought condition, buy it on the overbought. And we had some conversations. I said, you know what? It's working great. It's working great. But you understand the risk you're taking here. Yeah. And one of the saddest phone calls I've ever had with a trader is when he called me and he was at zero. It took him months to go from 2,000 to 120,000. It took him weeks to go to zero. All of a sudden, his Williams %R stopped working. What happened? The stock started dipping. The stock started to sell rallies. The stock didn't dip all that much. But he lost it all doing that method. My point isn't to kind of suggest that, hey, to do that or not. I think it's a very high risk, absolutely high risk, high reward strategy. And it's not applicable to most stocks. It's not going to work in most situations. But when the Williams %R starts working, it can be phenomenal. When does it start working? No. You take the top fundamental stocks in the market. For example, a Visa. One of the absolute top fundamental stocks in the market. And when the market vibe turns bullish, like it did right back here in January, and the Williams %R goes above 20, you buy it. And you run with it. You can use the 20-day moving average. You'll get whipsawed out a little bit here and there. But you take the top stocks. You could even take somebody else's list, like the IBD, Investor Business Daily, top stock list, and you can start to apply this. And you buy it when the market vibe is bullish and when the Williams percent R goes above 20. It works phenomenally. It doesn't work on the opposite. It doesn't work to say, well, market vibe bearish, and so I'll short something if it goes below 80. It just doesn't work very well. Tried it a lot over the years. Set up a lot of different tests. Doesn't work. You could argue most of my tests have been set up during bull markets, and you're right. But even going in back testing through various market conditions hasn't worked. Very choppy. You get the same thing guessing. But when you take the top stocks that are out there, you take the Chipotle Mexican Grill, for instance, and you say, okay, when's the next buy point? Well, when it gets above minus 20, or, gets above minus 20, and the market vibe turns bullish, there's your buy opportunity. To ride the next big trend, and that's ultimately what you're looking for when trading a Williams percent R, using a Williams percent R. You're looking for the next big trend. You're watching Apple. You're saying, you know what? Apple had a really bad day yesterday. I want to get back in. I wonder when I should get back in. I wonder when I should start to buy this again. What do you have to lose by waiting for the Williams percent R to move back above 20? Does Apple ever make its big runs without it? No, it never does. So, you're not going to call the bottom. You'll be like, everybody else out there. Calling bottoms is hard. Go apply the CCI. It'll be a little easier. But you can wait and say, I'll wait for the CCI to move back above 20, minus 20. Are there some stocks out there today that have the Williams percent R moving back above 20? Yeah. Here's AT&T moving back above 20. Now the market vibe's not bullish, at least not yet. We'll see what it looks like here in a little bit. But back above 20, that's the spot where you start to look and say the emergence of a trend is significantly higher. Williams percent R in bull markets, phenomenal indicator, and you buy when it moves above minus 20. The CCI in choppy, bearish, volatile markets, phenomenal indicator, and you buy and you sell, you buy oversold and you sell overbought. They're two indicators that look very similar, that have similarities in terms of overbought and oversold, but very different market style applications to them, but both can be incredibly effective and very, very fun to use. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.